The gravity problem is just unavoidable when the biggest reward is tied to attracting other agents. Well, for a traditional agent, a Thursday afternoon is for prepping a listing presentation, researching comps, generating leads. For an agent driven by revenue share, that same time slot often becomes agent attraction calls, networking for downline targets, making recruiting decks.
It's a completely different job.
The sources are filled with examples of top revenue share leaders openly talking about building downlines of hundreds, even thousands. If you're rewarded exponentially for adding more people, you stop acting like a listing agent and you start acting like a network marketer. And that creates a recruiting culture that just cannibalizes the time and focus you need for a real selling culture.
So the real estate world it's really seeing this huge shift. And it's happening kind of quietly, right under the surface of all those massive national brands we all know. For years, it felt like the firms that were defined by their sheer size, their huge agent count and that relentless focus on recruiting, they seemed completely unbeatable.
I did.
But our sources are confirming that, a major correction is happening. Experienced agents, the top producers, they're looking past the posters on the wall and the promises of passive income. They're demanding real, actual support.
That's really the heart of it. We're seeing this measurable exodus of really productive agents. They're realizing that the big box models are built to prioritize growth and headcount over, tangible day-to-day help with deals.
Right.
And so small teams and these specialized boutique brokerages are just surging ahead. They're winning not just with tech, but with a mix of speed, high-touch service from the broker, and this is crucial, really transparent economics.
So the mission for this deep dive is to figure out why.
Exactly. Why are these dominant models seeing agents flee? And then from that, can we extract a practical blueprint for you, the listener, on how the boutique models is actually built for success in 2025?
Okay, let's unpack this. We have some incredibly detailed source material that really dissects the economics and the culture wars happening inside these companies. It sets up a really clear contrast between a recruiting culture and a production culture. So if we look at these big national shops, the source material seems to suggest a fundamental misalignment, a mismatch between what the agent actually needs and what the company is built to give them. It often feels like all the energy is just going toward recruiting the next person, not helping the people already there close their current deals. So what are the key pain points driving producers away?
Well, we can really boil the frustration down to 5 distinct areas, and this is coming directly from agents who've made the jump.
Okay.
First, the economics are just. They're often way too confusing. The promise of profit share or revenue share, it masks a structure that's actually really complex and, frankly, unstable.
Unstable how?
Well, profit share only pays out if the local office is profitable. And revenue share, that requires you to hit all these difficult tiers based on the production of agents you recruit into your downline. It just creates massive uncertainty.
But wait, doesn't the scale of a huge national brand give you tools and resources that a little boutique could never afford? I mean, isn't that the whole point of all those tech fees?
That is a fantastic question, and it actually brings us right to the second and third pain points. The third one is what the sources call fee creep.
Fee creep. Okay.
Yeah, that generous 90-10 split or even 100% split, it looks amazing on paper. But then you start adding in the mandatory tech fees, office fees, insurance, transaction fees, franchise fees. The sources show agents calculating their effective split, what they actually take home, and finding it's way less competitive than a simple boutique flat fee model. The number they pitch you isn't the real number.
So you're saying the high-tech fees are just covering costs the agent didn't even realize were mandatory?
Exactly. And that ties right into the second big point. The severe lack of live support. Agents are paying for these broad national training classes, and there are a ton of them. But when they have a complicated live deal,
Like a weird legal issue that needs an answer right now.
Right now. A strange contingency, something that needs a decision immediately. The centralized staff is often overloaded, and getting help from a live broker is slow. You need an operator, not a receptionist with a training manual.
And that kind of delay can literally kill a deal in a hot market.
It absolutely can. And the last 2 points are all about culture. Fourth, the culture is just transient. When you have hundreds of agents, nobody knows your pipeline, your goals.
Yeah.
It's very impersonal.
You're just a number.
Basically. And finally, the fifth point. The loudest drumbeat is recruiting. The meetings, the conversations, the awards. It all points toward building your tiers, your trees. If the most celebrated agent is the one with the biggest downline, not the most closings, well, that tells you everything.
So the key takeaway here is pretty simple then.
It is. Experienced agents are done with motivational posters. They just need a broker who is a high-level operator and who creates real, measurable leverage for them from day one.
Here's where we get into the mechanics of that recruiting drumbeat. We really need to deal with the elephant in the room. These recruiting-driven models that pitch passive income. Our sources do a great job clarifying the difference between profit share and revenue share, which I think is essential for anyone listening.
It is essential, yeah, because both are designed to encourage agent attraction, but they have fundamentally different risk profiles for the agent.
Okay, break that down for us.
So think of it like this. Profit share, which was really popularized by Keller Williams, it pays agents a little piece of the profit from their local market center. It uses a 7-level tree structure, and it only pays when that local office is actually in the black.
So if the office doesn't make money,
you don't get paid. And the sources highlight that this system, while it was a powerful incentive, has faced some material, legal, and reputational turbulence recently. It got swept into the National Commission settlement framework. And there were separate lawsuits from former agents contesting changes to the vesting rules in 2024 and 2025. It just creates instability.
So if the market tanks or the rules suddenly change, that whole incentive structure can just collapse.
Precisely. And that's the big contrast with revenue share, which is what you see at firms like XP and Real. That system pays off the company's take from the top line commission, the gross revenue, before you even figure out local profitability.
That sounds a lot more stable for the agent who's recruiting, since revenue is, less volatile than profit.
It is, but it relies so heavily on those recruiting peers. The EXP model uses 7 tiers, and agents earn from the company's standard 20% side of the split. The sources noted that EXP even promoted a RevShare 2.0 change in 2025 to try and simplify the tier unlocks.
So make it easier to recruit, basically.
And Real Brokerage. They simplified it to 5 tiers, 5%, 4, 3, 2, 1, and they intentionally put the biggest payout at tier 1. But to get to those deeper tiers, agents have to maintain a certain production level or hit performance milestones.
Which usually means recruiting a base of producing agents right away.
Right out of the gate.
So, okay, regardless of the math, profit versus revenue, our sources point to this really crucial shared cultural outcome. They call it the MLM gravity problem. Can you define that for us?
Absolutely. The gravity problem is just unavoidable when the biggest reward is tied to attracting other agents. It just changes your daily work.
How so?
Well, for a traditional agent, a Thursday afternoon is for prepping a listing presentation, researching comps, generating leads. For an agent driven by revenue share, that same time slot often becomes agent attraction calls, networking for downline targets, making recruiting decks.
It's a completely different job.
It's a different job. The sources are filled with examples of top revenue share leaders openly talking about building downlines of hundreds, even thousands. If you're rewarded exponentially for adding more people, you stop acting like a listing agent and you start acting like a network marketer. And that creates a recruiting culture that just cannibalizes the time and focus you need for a real selling culture.
And this whole shift toward recruiting is often masked by this other promise: stock ownership.
Yeah.
Passive income that will compound and create generational wealth. But the public market, that's the ultimate impartial reality check. Agents get stock, or they can buy it at a discount. What do the charts actually say?
The data confirms significant volatility. It really challenges that narrative of a guaranteed wealth engine for the average agent who might not understand the capital markets.
Okay, so let's get specific.
Let's look at EXP World Holdings, ticker EXPI. Our sources are very clear. The all-time closing high for EXPI was $75.92 on February 9, 2021.
And 92. Wow, that's a massive peak.
It was. But the reality now is that the stock has traded primarily in the teens and low teens through much of 2025. That is miles and years below that peak. It just completely compresses the idea that every new recruit is sitting on some stable rocket ship of equity growth.
So if an agent got stock at, say, $30 or $50 during that recruiting boom, which a lot of them did, the value they actually got when it vested is a tiny fraction of what they were pitched.
Exactly. This is why the reality check is so important. When the main currency you're offering agents is volatile equity, it just undermines trust in that long-term promise. And the stock is often tied to hitting recruitment milestones. So when the value collapses, the reward for all that effort just disappears.
And the Real Brokerage, REAX, is it a similar story?
Yeah, Real shows volatility too. Its 52-week range in 2025 touched the mid-6s and the mid-3s. It's been trading near the bottom of that range through Q3 and Q4 and has had a lot of trouble holding its 2024 highs.
So this isn't investment advice,
Of course not.
But the volatility and the failure of those 2021 peaks to hold, it definitely complicates the whole narrative of guaranteed passive wealth for the average agent. It turns an asset into a speculation.
It forces agents to focus on their immediate operational income instead of some deferred speculative income, and that brings us right back to what agents actually want.
A broker who helps them close deals. Now.
Exactly.
So if agents are voting with their feet and leaving these big box models, what are they walking toward? The consensus seems pretty clear. They want real support, practical coaching, transparent economics, and the freedom to keep their own brand under a local trustworthy umbrella.
That is the boutique model perfected. Our sources highlight a great case study, Mangrove Realty in Delray Beach, Florida. It's led by founder Damara Cohn. She has over 24 years of experience, founded the firm back in 2008. She really is the ultimate high-level operator for her agents.
And what's fascinating about Mangrove is how they manage to serve both the experienced veteran who wants total freedom and the agent who needs daily guidance. What's their secret?
They use what the sources call a hybrid two-lane structure. So lane one is for the free agents. These are your seasoned producers who want total autonomy. They operate under their own brand, but Mangrove gives them high leverage marketing, compliance support, and most importantly, priority access to the broker for live deals.
So they get the support without being forced into some rigid system.
Precisely. They get prestige and leverage. Then lane two is for growth. That's the Mangrove Realty team. This is a smaller, more selective, coached unit that operates directly under Damara's guidance. They work company-generated leads, they write contracts, and they get that intensive hands-on coaching to accelerate their careers.
It keeps the energy focused on production, not recruiting.
That's the key.
So why does this boutique model work so well right now in this specific market?
It's three things, all centered on leadership. First, short distance to decisions. Instead of waiting 4 hours for some legal review queue, the agent just texts the owner directly. One source mentioned a critical negotiation that needed a legal stance in 5 minutes, and Damara texted back the approved language in 90 seconds.
The national brands can't touch that kind of speed.
No way. Second, high leverage support. They provide documented SOP standard operating procedures, those internal playbooks and marketing muscle that measurably reduces the time it takes an agent to get a listing under contract.
And third,
operator energy. Damara's 24 years of experience navigating complex cycles like short sales in the past, that provides real, grounded leadership. She's done the work, so she can coach the work.
That blueprint is incredibly valuable. For anyone listening who might be running a team or thinking of starting a boutique, let's summarize the 4 actionable steps to scale this model without losing that high-touch culture.
Okay, here's the blueprint right from the case studies. 1, make the agent your client. You have to deliver documented SOPs, a knowledge base, and live broker help from the actual decision maker. Response time has to be measured in minutes.
Right. 2, fair, simple economics.
Yep. Predictable splits or flat fees that are clearly tied to the value you provide. Agents need to be able to do the math easily.
Okay. 3, execute the 2-lane structure.
Maintain those high autonomy free agents alongside a small, intensely coached team. It protects your culture while letting experienced agents thrive.
And finally, 4, recruit for fit, not headcount.
The source material calls it building a locker room, not a stadium. You have to be ruthless about maintaining high standards and protecting that shared production culture.
So what does this all mean? The ultimate choice for an agent or for a broker building a business, it really seems to come down to the fundamental identity of the company. Where does the leverage come from?
That is the defining factor. If the loudest conversation inside a brokerage is about unlocking tiers, building downlines, and how to get your friend to join, it is fundamentally a recruiting culture. It's built on speculative income.
If the daily huddles are focused on listing presentations,
offer strategy, solving complex contracts, then it's a production culture. It's built on measurable client service. And experienced agents are voting with their feet for that second one because that's where the reliable income is.
So this shift is really more than just economics. It's about valuing proven operational excellence over just sheer scale.
And that leads to a final provocative thought for you to consider. For a boutique to scale successfully without, diluting its high standards and culture, that crucial locker room feel, the sources emphasize you have to document your playbook and use tech to eliminate noise. But here's the key balancing act. You can never use tech to replace leadership. The immediate availability of that broker operator, that's the competitive advantage the big decentralized models can never truly replicate. And at the end of the day, it's a people business run by people.